Hi, everyone. This is Jason Barrack of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He is CEO of Santiago Capital. He's a gold market expert, and he's a follower of the Austrian School of Economics. Brent Johnson, thank you for joining me again.
Yeah, absolutely. Thanks for having me back. Always enjoy talking to you.
Now, Brent, you just put out a new video comparing the global economy kind of to the battle with Marvel superheroes and Marvel villains. But what are your thoughts, if you could summarize them, on the global economy?
Sure. Well, that's it's a pretty broad question, but I'll try to summarize them a little bit if I can here. And that is, after 2008, the world really just got turned upside down, and the central banks came in and just flooded the market with liquidity. And, a lot of things happened that people never thought that they'd see happen. And the big theory was that all this liquidity was going to be inflationary. And the interesting thing is that for years and years and years, it didn't really produce any inflation. And actually, you could argue that it was a deflationary issue rather than an inflationary issue. And I think in the last, I don't have the exact number, but I think if you add it all up, it's in the $20 trillion range that they've either printed or, used for bailouts for the global economy if you add up all the different central banks. And the thing that I find really interesting is now, 10 years later, after they started this, when initially, they were going to do $1 trillion, whatever, and everybody thought this was going to be very highly inflationary. Now we're 10 years later, it's 20 times that, and everybody's still kind of in a deflationary mindset. I shouldn't say everybody, but there's still a lot of people who are in a deflationary mindset. They think that we're still going to go back to lower rates, maybe even negative rates, and the Fed's going to have to revert to QE. And I just don't think that's the case. I think that I don't think things are as bad as everybody else. Or I shouldn't say everybody else. I'm using a very generalized statement. I don't think things are as bad as a lot of people think they are. Now, don't get me wrong. Anybody who's heard me talk before knows that I think that in the end game, this is all going to end in tears, right? This has all been played out before in history. Central banks have always, come to the rescue, and they've always provided the liquidity that was necessary. And it usually works for a couple of years, 5 years, 10 years, or whatever, and then you end up, in a worse situation than you were to begin with. And to be clear, I still think that's the case. This is not going to end well. But I just don't think it's going to end right now. And I think for a couple of reasons, we have some things happening that it's going to extend the game longer than most people think, longer than I initially thought it would happen. But I just think that's where we're at. And I think we are starting to see some pickup in growth in the United States. I think we're starting to see some inflation. I think rates are going to continue to go higher. I don't think we're going to go back to QE, and I can kind of get into why that is. But from a big picture standpoint, I think the U.S. is going to do better than the rest of the world. And it doesn't necessarily mean that I'm calling for calamity everywhere else. But I think on a relative basis, we look pretty good. I think on a relative basis going forward, we're going to look better. And I think that when this whole thing comes down, we're going to be the last man standing before we eventually fall ourselves. So that's kind of my summary. And, we can, dig into that in any way you want to. But that's where I think we're at right now.
So you said that basically there hasn't been any inflation. So then you wouldn't consider, based on your definitions, you wouldn't consider asset prices, basically the Dow going parabolic the last 12 months or so, high bond prices, high real estate prices, basically the everything bubble. You would not consider that inflationary then?
No, so that's a very good point of clarification. And, if you actually even take it back further than that, if you take it back to what inflation initially meant to begin with, and inflation really started off as, an increase in the amount of money in the system, right? If you increase the monetary base, that was inflation, and the knock-on effect from the inflation was then higher prices. So now we look and what's happened, and when I said a minute ago that there wasn't inflation, I probably should have clarified that there hasn't been this runaway consumer price inflation that many people thought when they initially rolled out these government stimulus programs. When those were initially rolled out, everybody thought yields were going to, or that inflation would spike, that we would have this, a negative gearing on the economy, that, the central banks were going to try to inflate their way out of the system. And what happened was because they gave the money to the banks and not to the people, there was no velocity of money. The banks just put it on their balance sheet, sat it on their reserves. They get paid from the bank from the Federal Reserve to hold on to it. So while the monetary base increased, there was no increase of velocity, and there was no money injected into the real economy. And so you got this tremendous asset price inflation, but you didn't get the runaway consumer price inflation that many were expecting. So as a result, I think everything is in a bubble. Real estate's in a bubble, stocks are in a bubble, bonds are in a bubble. I guess you could argue that commodities are not yet in a bubble because we didn't get that consumer price inflation. But, I think, if central banks were to be gone from the world tomorrow, asset prices would be lower across the board, all asset prices. Now, which one would hold up relatively better than all the others? I would probably say gold. But it doesn't change the fact that everything's in a bubble, and it's just a matter of which one's going to deflate first.
That's more in agreement with exactly the way I was thinking. Yeah, I wanted you to, because I know you follow the Austrian School of Economics. Yeah. I think the mistake that a lot of the modern Austrian School economists make, and if you go back and actually read, Murray Rothbard and Ludwig von Mises, sure, they say that the monetary inflation, like you said, they actually predicted it would go into the capital markets first, not the real economy. Right. But the modern ones, as soon as those, bank bailouts and QE, they were screaming at the top of their lungs. Even Peter Schiff were screaming for hyperinflation for a long time.
Sure. And, and I'll be really honest. I initially thought the same thing. 2009, 2010, even into 2011, I was one of them. And, the reality is I was wrong. And I think where a lot of people, either in the Austrian school or in the gold world, or, kind of the alternative markets, they're not willing to admit that they were wrong on the effects. Now, they may say, oh, it's still going to happen, and that may very well be true. But the fact is that a lot of us, me included, 7, 8, 9 years ago, thought we were going to get this runaway big inflation. And the fact is it just did not come. Now, you can argue that there's a lot of reasons why that didn't come. You can argue that it's eventually going to come. But the fact is it did not come yet. And so, when it didn't come, I kind of really took a hard look at everything and trying to figure out, well, why didn't it come? I didn't just say, well, it's eventually going to come. I had to sit there and really think about and kind of analyze things, why it didn't come. And, that led me to a couple other ideas and theories and being able to, allocate assets differently as a result. But, I should probably point out that even though I came to the Austrian school in, let's call it 2007, 2008, and 2009, not because I necessarily had a big interest in it, but because I was just trying to figure everything out. I knew in 2007 that something was wrong. I knew the housing prices were out of control because, just looking at housing prices in the Bay Area, it didn't make any sense. And, I was working at Credit Suisse at the time, and the markets were just going up. But I could just tell something wasn't right, but I wasn't smart enough to know why it wasn't right. So I started, and I couldn't ask anybody else at Credit Suisse because they just said everything's fine, buy the stocks, and so keep your sales up and everything will be fine. And that just didn't work for me. And so I kind of started this process of self-discovery and self-education, and I came across the Austrian school at that point, and really everything I read on there, it just made sense. It was logical, it followed through what I thought really happened in the real world. And so when I say I'm a follower of the Austrian school, it is true. I tend to agree with the stuff that I read from the Austrian school more than anywhere else. But, I didn't study through the Austrian school. I don't have a degree. I didn't go to college where there's an Austrian school. I've never taken a class. But whatever I have is self-taught, and some of that may be correct. And, the truth is some of it may be incorrect. But I do tend to lead towards the Austrian theory. Anyway, that's a little bit of a ramble, but that's just a little bit of how I came to be here.
Your story of how you found the Austrian School of Economics is very similar to mine. And the Austrian School of Economics, there is no degree because the teachers won't get professors because the Keynesians run that.
Right. Fair enough.
So none of the Austrian school, except for maybe like one university where they have like one professor, right. There's no department that's going to give any of those guys tenure. So do you think that, how would you classify then 2017? Would you say 2017 was the year that the other central banks who were coordinating with the Fed, like the Bank of Japan, the European Central Bank, that was the year that they took over the crazy amounts of liquidity?
Yeah, and this is kind of one of the things I tried to point out in my recent presentation, titled Marvel, which I think you saw and, a number of people saw. And if anybody wants a copy of it, I'm happy to send it to them. But, a lot of people thought, the Fed will never be able to taper their bond purchases. Well, they tapered their bond purchases. Then they said, well, they'll never actually be able to stop. They may be able to taper, but then they'll never be able to stop. Well, then they stopped. Well, they'll never be able to raise rates. Well, you know what? They've raised rates 5 times now. Then they said, well, you're never going to be able to sell any of the bonds. Well, you know what? They've started. Now, you can argue that, it took a very long time and they're being slow and that it's still going to see the negative effects. But the point is they were able to do a lot of things that many people thought that they were not going to be able to do. And the fact is they did stop the stimulus here. They have raised rates here. But the rest of the central banks of the world, as you point out, are still printing. So much so that even though the Fed, if you take the Fed at their word and you agree that they're going to reduce their balance sheet at the rate that they say they're going to, 2 or 3 years from now, the central bank balance sheets of the world will still be higher than they are today. In other words, they're still growing despite the fact that the Fed is now tapering and trying to, reduce its balance sheet. And so the point I try to make in my presentation is there is plenty of liquidity in the world. There is plenty of money still being printed. It might not be taking place out of New York City anymore, but they're printing a hell of a lot of money in Frankfurt and they're printing a hell of a lot of money in Tokyo, not to mention all the other stimulus effects around the world in other markets. And with today's, global economy where capital flows around the world, at light speed, you don't have to live in the country that's printing the money to get the benefits of the printed money. In other words, if they print money in Frankfurt, it can easily wind up on a bank balance sheet in Atlanta or New York City or Los Angeles. If the branches of the governments, if the branches of the banks in the countries where they're getting stimulus have branches in the United States, all they got to do is transfer that balance to that branch in the United States. All of a sudden, rather than paying a negative interest rate or being charged to hold on to their deposits, now all of a sudden they're earning, a tax-free, risk-free return just by holding cash in the U.S. And if they decided, they can even lever it up and put it out into the economy and, buy the stocks or buy other assets or find its way, loan it out, get it into the real economy. And so, I think you've got this big carry trade going on with, cheap funding overseas going into U.S. markets, which on a relative basis look pretty good. And so I think there's plenty of money still being printed. I think the fact that we're raising rates makes us look more attractive on a relative basis than the rest of the world. We don't have any, you could argue we have some, but we have very little in the form of capital controls. Capital flows pretty freely. There's lots of different investment options once you get here. We just passed the biggest tax cut in 20 or 30 years that will provide even more benefits to corporations who hold money here. I think the fact that we have higher rates and that we're incentivizing companies to do business here will draw capital to the U.S. So that money gets printed overseas. I think it flows to the U.S. I think it gets either put into this cash-free return that at the Federal Reserve, or it finds its way out into the market. And as a result, I think we're probably still going to get asset price inflation. It's very possible. So, and as a result of the capital flows, I think the Fed could continue to raise rates, and I think they will continue to raise rates. Now, I think as those rates rise, it's possible that the yield curve in the United States will invert, because I'm not sure that the long rates are going to rise. It won't surprise me if they do, but I don't think it's likely that they rise at the same rate as the near term rates. And so you get into the situation where you have an inverted yield curve. And people always say, well, this is a harbinger for a recession. And that's true. It typically happens when you get an inverted yield curve that you eventually get a recession. But it usually doesn't come right away. It usually comes, 12 to 24 months later. And sometimes the recession comes even later than that. And the interesting thing is that in that time period when the curve is inverted before the recession comes, an inverted curve is actually very inflationary. If you can borrow long term at 3% and you can invest short term and make 6 or 7%, that's a pretty good, spread. And maybe you can make even more than that. And so, the fact that, that leads to these animal spirits, and it leads to even more inflation, and it leads to even crazier ideas, that's what brings about all the excesses, which then lead to the collapse, right? And I think you could argue that we're already in the age of excess. I think you could already say that valuations are already stretched. But my point is that despite the big bubble in the equity market, I think there's just as big a bubble, if not bigger bubble, in the fixed income market, in the bond market. And with rates going higher, I think it's very possible that bubble breaks before the equity bubble. And so if you get this, perfect storm of capital flows coming into the U.S., capital flows leaving the bond market because it's not what it used to be, and you get money going into the equity market because it's a better option than bonds. I think we get into this melt-up scenario where rates are going higher. You're going into stocks because you want to outpace rates. You get these inflationary pressures, and you want to outpace inflation. More, and that draws even more capital flow in because rates are higher. I think we get into this melt-up scenario where in the next 2 or 3 years, equities go much higher, bonds go lower, and then it all just, it all ends very badly. I just don't think it ends, tomorrow or next week.
Now, this sounds like a crack-a-boom scenario, like from von Mises,
exactly.
where, the real economy is not benefiting necessarily or benefiting as much as the asset prices are. And basically, the distortions or the separation from reality gets worse and worse and worse. But to put 2017 in perspective, not even counting the Federal Reserve, the Bank of Japan and European Central Bank put over $3 trillion in liquidity into markets, an insane number. What's even more insane, Brent, is that the People's Bank of China put more liquidity than the Federal Reserve, the Bank of Japan, and the European Central Bank combined in 2017.
Right. And, we're not getting as much benefit there because China has capital controls to keep that money inside China, right? If they didn't have any capital flows or capital controls, I'm fairly certain a lot of those capital flows would be leaving China and coming here. Now, not all of them. Listen, China's an amazing country. They've done some amazing things. They're going to do amazing things in the future. But, it's not a fantasy land in a perfect world that everybody thinks it is. They've got some very large, very serious problems that they're going to have to figure out how to solve. And I think many people in the world think that just because they're smart and they've got 1.4 billion people and they can throw all this manpower at the problems that they can just automatically solve them, and that they're not going to have any challenges. And I just think that's completely wrong. I think they have some serious challenges. I don't think they have them figured out. I think they're trying to figure them out. But, a couple of years ago, a friend of mine who runs a hedge fund out of London called Astalon Capital Partners, he did an analysis, and he showed that the rate of return that China gets, the amount of GDP growth that China gets for each dollar borrowed, for them to hit their 2020 GDP goals, they need to borrow just in the next 4 years or next 3 years, another $20 trillion on top of the $30 trillion that they've already borrowed. Now that's far and away the biggest credit bubble in the history of the world. Now, can they do it? I don't know. You can never say never, but I think it's unlikely, right? So, and even if they are able to do it, they end up with a massive debt problem, that makes ours look small. So,
I don't think they can. Sorry to interrupt you. I don't think they can do it without devaluing their currency. And they're going to have to do some type of bailouts for their municipalities, for their banking system. And so a lot of these pro-gold, pro-China people, and it's kind of weird how we have people who are libertarians and Austrian school people in the gold camp defending China when, China is a Keynesian central planning disaster with a credit bubble, and then, their civil rights problems and human rights violations and lack of liberties. It's just kind of a head scratcher.
I agree with you. I talk with people a lot of times on phone, in person, over email, on Twitter. And, like you said, you'll talk to a lot of these Austrian thinkers or gold advocates who will, throw daggers at everything the Fed does. But when you start talking about the ECB or China or Bank of Japan, they kind of give them a pass. And I find that to be kind of odd, I guess is what I said.
I completely agree. I think it's an anti-U.S. bias. But in my humble opinion, I don't think any government is doing a good job. All this central planning, all this credit. But the main question now is, these central banks in 2018, Brent, they claim they have an exit strategy. They claim they're going to take the punch bowl away. They claim, they're going to magically have a soft landing. The asset prices aren't going to crash. Do you think they have a viable exit strategy?
That's such a hard question. I would say...
Not a hard question for me.
I would say that the U.S. has a better exit strategy than anybody else, even if they don't know it. So like I said, I think if the Fed continues to raise rates and draws capital here to the U.S., I think that will actually be a benefit as opposed if they were to stop raising rates and they were to in fact lower rates or even go back to QE, I think the markets would crash because I think then they would say, everybody's they've kind of pulled people along saying, things are slowly starting to get better. And now they've got people kind of going that way, and rates are starting to rise. If they reverse that momentum that took them forever to get going, I don't think they'll ever get it back again. So I think in order to keep it going, I think they need to keep the narrative. They need to keep raising rates, draw other people's capital to the U.S. Let us use, I used the example of drinking their milkshake, right? Everybody else is pushing liquid into the system. If we put a straw in and start sucking it out, we get the benefit while they're doing all the work. I think that's so. I don't know whether the Fed is smart enough to realize that. So I don't know that I want to give them that much credit. But if they do that, I think the U.S. will be on a relative basis better than everyone else. And quite honestly, I think what's going to happen is that these capital flows are going to lead to a dollar bubble, and where the rest of the world is going to beg us to devalue. And I think everybody will probably do some kind of a joint devaluation, 2, 3, 4 years down the road. And then that will lead to, the runaway price inflation.
Would be kind of like 1934, then how they tried everything else, and then FDR, with a recommendation from John Maynard Keynes, he devalued the dollar against gold?
Yeah. So think about it now. Think about what's just happened in the last year and then in the last 3 weeks. Last year, at the beginning of last year, everybody was a dollar bull, and I was one of them. So in the summer of 2016, I put out a presentation called Step into Liquid, where I argued that the liquidity in the world was going to end up flowing towards the dollar from other currencies. The dollar was going to be in a bubble. It would cause all kind of problems, and that's what would lead to gold eventually rising along with the dollar, and eventually gold would be the last man standing. And that played out pretty well in 2016, and I stayed with the same theme, a year ago, and for the last 12 months, I've been completely wrong. The dollar rolled over, and it's gone down, and it's kept going down. Now, in the last 3 weeks, the dollar has fallen 4 or 5% this year already. In that same time period, the euro, went from 120 to 125. So much so that, just 2 days ago, as that was happening, the U.S. Treasury Secretary made a comment that, a weaker dollar is great because it helps our exports, it helps our economy, which pushed the euro even further. So much so that Draghi, who was finally starting to get a little inflation showing up in Europe and finally starting to see some payoff from all of the extraordinary measures that he's done, had to come out and make a comment today, which were very dovish, saying, we're not planning, I can't see any rate hikes happening this year. And the fact that these other people, and he didn't say, Secretary Mnuchin's name, but he said these other people, talking about exchange rates, it goes against agreed upon principles. So the fact that the dollar's weakening so much against these other currencies, I don't think that those other central banks are just going to sit by and let it happen. And I think for the reasons that I've laid out in my various presentations, I think the dollar is going to get stronger. And so what I think is going to happen is I think then Trump came out today. I don't know if you saw this. Trump came out today and said, the dollar was just on its knees. And Trump came out to say and said, no, the secretary was, misquoted or taken out of context or it came across wrong. And he said the dollar's going to get much stronger, and that started. Now, we'll see if that lasts.
6 months ago, Brent, didn't he say the exact opposite? I mean, he said he wanted a weaker dollar. Right?
He might say something the exact opposite tomorrow. Who knows what Trump's going to do. But my point is, I think if the U.S. sits back and just lets the currency appreciate as the rates rise, I think the rest of the world will end up begging us to devalue because the rest of the world owes $10 trillion in dollars. So if the dollar continues to weaken, that actually helps them a little bit. So, I think we're just in this really weird place. And I should clarify something. Just because I think that the U.S. is going to get stronger on a relative basis doesn't mean that I think the Fed is doing a good job. It doesn't mean that I respect the central bankers. I don't know if there's a group in the world that I have less respect for than central bankers, and that this is all going to end in absolute tears. I'm just trying. My job is to kind of look at the market, look at the policies that the economies around the world have put in place, and that the central banks have put in place, and that the various governments have put in place, and figure out where capital is going to be most attractive and have the best returns, throughout this path, right? Before it does end in tears. And my analysis tells me that on a relative basis, equities are going to be better than bonds, and that the U.S. is going to be better than the rest of the world. That doesn't mean it's going to be smooth. It doesn't mean it's going to go in a straight line. I would actually love it if we could get a 5 or 10% correction in the equity market here, because I think that would take some of the froth out of it. It would take some of the animal spirits out a little bit. I think, the melt-up might come in the next 6 months if we don't take a little bit of froth out of the market, right?
I hope you're enjoying our interview with Brent Johnson. We'll be right back to him after a word from our sponsor.
Do you work out routinely and eat healthy almost all the time? If you eat paleo or vegan or work out routinely, you may be eligible to save up to 33% off on your life insurance thanks to Health IQ. Health IQ is a venture capital-backed, big data technology life insurance company that offers customers life insurance at special rates by using the latest technologies. For more information, please go to healthiq.com/WS4MS. That's healthiq.com/WS4MS. The CEO of TD Ameritrade just said he's never seen such record low cash amounts in his in the accounts of his customers.
Yep. The interesting thing is listen, and I don't want people to think that I'm ignoring all these signs. I get it. This is going to end poorly, right? This has been tried before. It never works. It always fails. But the same arguments were there in October, and since then the market's up another 7 or 8%. The arguments were there last January. Since then the market's up 30%. So you just kind of got to be, if you actually have to make a decision of where to allocate capital, and you don't have the option of sitting on the sideline. That's the business I'm in. Now, don't get me wrong. We have some cash on the sideline. You should always have some cash on the sideline. But if you're placing some of that cash into the capital markets, trying to get some return on your money, I think bond investors need to be very careful here.
From a historical perspective, this kind of reminds me of a couple years before the 1929 crash, about how a ton of money came into the United States from other capital markets, and how the margin debt in the United States a couple years before the October 1929 crash just exploded. So, we're not quite there where, the odds of the probability of a 1929 crash are high yet, but we're getting there.
It'll happen at some point. The interesting thing about the 20s is, they called it the Roaring 20s. And from 1921 to 1926, the stock market advanced 200%. And at the end of 1926, the yield curve started to invert. So if at the end of 1926, if you saw that the market had gone up 200% and the yield curve was starting to invert, and as a result, you decided to take your money out of the stock market and put it into long-term treasuries, over the next 2 years, you would have lost 30% in U.S. Treasuries while the stock market more than doubled again. So the point is that, yes, there's bad things that are going to come in the future. Yes, there are some signs that you need to be watching out for and be careful of. But it doesn't mean that selling everything and buying Treasuries right here is the great answer. That once the yield curve inverts, you think about it, an inverted yield curve while it lasts is extremely inflationary. And sitting in cash during an inverted yield curve may ultimately pay off, but in the year or 2 years it takes for that to eventually show a recession, you could lose a lot against inflation.
Yeah, so a lot of these central bankers and the heads of treasury departments, they've been taught at pretty much the same group of economic thought in school. So I think, they're using a lot of mercantilism. Ultimately, Brent, I think I talked about the 20s and 30s. I think we're headed back to trade wars. I think we're headed back to tariffs. I think that's the way we're going with competitive devaluations. Maybe we have like the Bank of Japan, the European Central Bank, and the U.S. on one side of the currency war versus China or the emerging markets on the other. But I think there's a debate, and we have mutual friends, and I've discussed this with mutual friends. There's like a debate in the hedge fund community, the very sophisticated investors, over whether the U.S. will collapse first or China will collapse first.
Yeah.
So maybe you could share your views on that, because
Sure.
I actually think one of my good friends, Louis Camersano over at Small Gold, he actually, before I let you speak, he actually just had this last point. He actually said that he thinks that the most bullish thing for gold would be if China actually collapsed, because he's basically said the last couple of years the Chinese government hasn't added a lot of physical gold. They basically, with their trade reserves, they've been using it for bailouts to protect their currency and other stuff. So what's your views on that too?
Well, it's interesting. I was I think it was on Twitter a couple weeks ago. I was involved with him and 3 or 4 other people in kind of a debate about this exact thing, and I tend to agree with him. But I should clarify some things. To be clear, I think that when all this goes down, I think the U.S. will be the last man standing. So if I had to choose between who would collapse first, between China and the U.S., then I would say that China would collapse first. I don't know that either one of them will completely collapse, but I would pick China to collapse first. Secondly, regarding whether that would be bullish for gold or bad for gold, if China were to collapse or if China were to devalue their currency in a big way, I would say that in the few days and maybe even to a week after that happened, I think that would be very bad for gold. I think if China were to devalue their currency tonight, I think between now and the middle of next week, gold would probably see $700 or $800 because that would be an extremely, extremely deflationary event for the whole world. And things would need to get liquidated to pay margin calls, and there's nothing more liquid than gold, especially in a crisis. And I think gold would get liquidated to pay for those margin calls. Now, that said, if you got more than a 1-week time frame, I don't know that there could be anything more bullish for gold than China collapsing, because it would lead to a new monetary system, most likely. There'd be chaos as people try to figure out what the hell we're going to do next. And once that initial liquidation would take off, I think gold would turn around very quickly. And now we're talking gold at $4,000, $5,000, $8,000. I mean, I don't even know what number it would be, but it would be a lot higher than it is now. I think it depends on your time frame, but I would tend to say that initially gold would suffer, as everything would suffer. All assets would suffer on a China deval, but very quickly gold would turn around and be the asset of choice.
I think that's some interesting points you brought up. I disagree with that because I think Chinese citizens, we've seen this recently when China has done devaluations in the past, as recently as 2 years ago. And we have hedge fund managers like Kyle Bass making big bets that China will devalue. He's been wrong for 2 years. At some point he's going to be right, but he's been wrong for 2 years. They will probably have to devalue. Most people think at least 20%. If they did a really big devaluation, 20, 30%, Chinese citizens would go crazy buying gold, silver, and Bitcoin. I think you'd have big spikes within maybe a week or two time frame. You'd have just indiscriminate buying of Chinese small business owners in the private sector, high net worth Chinese, even emerging middle class Chinese saying, you know what, I'm not going to let the government take 20 or 30% right off the top from me. I'm putting it into crypto. I'm putting it into gold and silver.
Yeah, I mean, you might be right. Like I said, I think initially it would go down on liquidity issues, but very shortly after that, gold would be the asset of choice.
Do you think then that China actually wants a gold-backed currency, or do you think then, given their credit bubble, that they really can't physically do it then?
No, both. I don't think that they want it, and I don't think that they can do it. China is maybe they are better capitalists than we are. You could make that argument. I probably wouldn't argue too hard. But they are still a centrally planned economy. I mean, you could say the U.S. is capitalistic, but you could also say that we're centrally planned as well, right? So I don't think China is less centrally planned than we are. In fact, they are still a communist country. Maybe only in name and maybe not in action, but more so than we are. And forget whether you're a communist country or a democratic country. I don't know a politician on earth that would willingly go back to a gold-backed currency and a gold standard, because it takes away their ability to spend whatever they want to spend. It takes away their credit card, and it imposes handcuffs on them. Now, if you name me one Super Bowl winning coach, NCAA winning basketball coach, NBA Finals winning coach, any S&P 500 CEO who really believes in democracy and believes that everybody on their team should make the decision rather than them making the decision, then maybe, we can have a different, conversation. But at the end of the day, leaders of big organizations want the power to flow down. And there is no way in my mind that Z wants a gold-backed currency or a gold standard. Now, that doesn't mean that he doesn't want to have the option, right? The great thing about gold is if you have enough gold, you can tell everybody else to, go to hell, so to speak, and do whatever you want because you have the gold. That's the old saying: whoever has the gold makes the rules. I think Jim Richards is the one that said, they just want a seat at the table.
Oh, Richards, yeah.
and I agree with that. I mean, listen, I don't think any government wants a gold-backed currency, but the fact that you can back it gives you a lot of power. And the country that has the most ability to do that is actually Russia, as opposed to China. Russia has far and away the biggest gold reserves per their monetary base of any G8 country. It's not even close.
So you don't think their crypto ruble will worth then?
Crypto is another thing. Crypto is fascinating. There's a lot of people in the gold world who don't like crypto or who see it as a Ponzi scheme or whatever it is. And listen, there's a lot of problems in the crypto world. There's a lot of problems in the Bitcoin world. I don't think Bitcoin itself is a Ponzi scheme, but that doesn't mean that there's not, companies and different things going on in the crypto world or the Bitcoin world that don't have some of those characteristics. But I'm a Bitcoin fan. I think these digital assets, I think they're here to stay. I don't think they're going away. There's a lot of things that they need to figure out before they actually become a viable currency or a viable medium of exchange. But they're incredibly powerful. In many ways, they're better than the system that we have now. And I don't think they're going away. I think people should take them seriously. And I think there will be a handful of them that are still here 5, 10, 20 years from now.
Yeah, I agree. And I think there's a lot of innovation going on. And I think governments for now have decided that they're just going to tax and regulate them. And then they're going to they're in the nefarious way, they're going to try to take the technology behind Bitcoin and these other cryptocurrencies, the blockchain technology, and they're going to try to use it for, nefarious purposes. As a libertarian, they're going to try to use it to implement a cashless society. So they can track and tax every transaction. So, people can't pay cash off the books then and not pay taxes.
Yep, I'm with you.
So let's transition then to gold for the rest of the interview.
Yep.
So in your opinion, why did gold start to rise in 2017?
Well, I think it was a couple things. One, I think we started to get some, there were still some negative interest rates. Interest rates started to rise, but some inflationary pressures were, I think, rising faster. And so I think that helped gold a little bit. The fact that the dollar fell 10%, I don't know that gold went up because the dollar fell. I actually think we're going to get into a period where dollar and gold rise together. So I don't think that there's a one-for-one inverse correlation. That said, it certainly didn't hurt gold that the dollar fell 10%, right? It wasn't that headwind to gold that a strong dollar would have been. So I think that's a big part of it. I think also, the fact, I think it was just a continuation of what really started the year before was, 2 years ago at the Davos World Economic Summit, that happens to be going on right now this year, 2 years later, is where they started talking about negative interest rates. And that's what led to the big initial breakout in 2016 of gold. Then we had the big correction, at the end of 2016.
More like manipulation, I think.
Well, potentially. I'm sure there's some of that. So we can touch on that next if you want to. So we had a big swing up, we had a huge swing down, and then we had it's kind of like a pendulum. When a pendulum starts swinging, it's going to swing back the other way before it comes to rest as well. So we've had these big swings in gold for the last, call it 48 months or 24 months now. And we had a big swing up last year. It started to swing back down, and then it swung back up big at the end of last year. So much so that we're now at a place where I just think there's a lot of headwinds to gold right here. I hate saying this because I'm a very big gold advocate. I think everybody should have gold in their portfolio. I think gold is going to be the asset that everybody ends up being very, very happy that they had in their portfolio, because I think it's going to save a lot of people. That said, in the last 6 weeks, we've seen gold from having a daily sentiment of, in the low teens to now in the low 90s. The relative strength is off the charts in gold. The commitment of traders, the speculators are back up and having huge long positions, and the commercials, which are typically seen as the smarter money, quote unquote, are back to a big short position. The dollar has absolutely gotten clobbered last year and the first 3 weeks of this year. Even if you hate the dollar, even if you think it's going to zero, it's due for a bounce. So I think right here, gold is right now back where it was. It's kind of, again today, it hit basically the level that it hit in each of 2016 and 2017 before turning back down. So, I said in my presentation last week, I think we need to pull back a little bit to kind of take a breather, regain some of our energy in order to kind of break through that very stiff resistance right above us here. But listen, I could be wrong. I'm not one to bet against gold. I think it's a very important part of someone's portfolio. And if we can break through this, these high 1300s into the 1400 range at the end of the month, or into later in the spring, then maybe I'm wrong, and maybe we're now into the gold bull market, and then the bear market is definitively over. I think when that happens, we're going to have a very nice run in gold. I just personally don't think it's here yet. If I'm wrong, I'm happy to admit I'm wrong, and we'll go from there. I don't think anybody should sell their gold, but if I have some hedges on our portfolio, and I think it's due for a pullback.
The dollar index hit 89 today on January 25th. I have a 5-year chart of the dollar index now.
Yep.
It looks like it tried to bounce, Brent, a couple months ago, and it's been in a downtrend. So, maybe it will reverse course here. Maybe the central banks will intervene, because God knows there is no free markets in the currency markets, and they do step in and intervene.
Right.
So I think, though, gold's bull market has restarted. Obviously I'm not going to predict super higher gold prices immediately, but I don't think the gold price can basically stay flat at these levels for many years more, or go lower for many years more, like a lot of gold bears have predicted, because honestly, I don't think the gold miners can continue to produce the supply at the levels that the market needs. And so I don't believe in the gold stocks of flow argument, because a lot of the above ground gold is not available to hit the market. So basically the annual mining supply is the amount of physical gold that's required to prevent the price from really spiking like crazy.
Yeah, so I think it's going to be interesting to see how it goes. I think this, like I said, I think we're at a very key level. If we can break through these levels, get to 1400, stay there, maintain that, and work our way higher into the summer, into later in the year. I think at that level, gold companies can make a good profit, and I think that they can, start to expand, and you'll start to see some mergers and acquisitions, et cetera, et cetera. But I think we need to get through that space before, I don't, in our fund, we don't own any miners right now. We sold them a year and a half ago, and we haven't bought them back yet. And like I said, I may end up being very wrong. I may end up buying them at much higher prices than they are today. I just feel like we're going to get a better opportunity to buy them here sometime in the next couple months.
The 1-year gold chart's pretty interesting. It looks like it set up a pretty textbook bullish inverse head and shoulders chart pattern, and then even the most recent pattern there, the last couple months since basically December, has been a cup with a handle, although obviously it's had a correction recently. But what you said on the COT normally means that they're trying to stop that breakout because they can see it coming.
Yeah, sure. And so it goes back to it really goes back to my dollar argument. Many dollar bulls have died along the wayside over the last 12 months. It's been a totally wrong call. The dollar's gotten absolutely hammered. So, I've been wrong. When I look at the fundamental drivers in the world and the reasons that I think that the dollar is going to get stronger are still there. I think, while it's definitely on the ropes, I think the tax plan, I think the Fed raising rates, I think a number of other things are going to lead to the dollar getting stronger in the years ahead. And I think initially I think the dollar needs to break back out before gold breaks out. Now, like I said, I can be wrong, and if I'm wrong, I will admit that I'm wrong and I'll move on. But as of right now, I still think that the dollar breakout comes first, and once the dollar's broken out, then I think gold follows it, and I think they go up together. So, we'll see how that works out. I'm not a very popular gold bug right now, but that's kind of how I see it.
Well, as a contrarian, I think, on pullbacks, I think it would be good to accumulate, either start gold stock positions in quality ones or add to. So, obviously wait for pullbacks, because in my opinion, the market's manipulated, the gold market is, so you don't have to chase the price. You can wait for the smashes to come in, and you can go in and buy on, weakness.
Yep, that's right.
Well, let's talk about then maybe some things you think are high probability events for 2018. True or false? Do you think we're going to have more asset price volatility in 2018?
Yeah, that's probably. I was thinking about that question because, last year was the lowest volatility year on record, right? I mean, there was almost no volatility. Just had a nice smooth ride up in the equity markets. Volatility stayed below. So it's pretty easy to come and say, we're going to have higher volatility this year than last year. So I think that's true. I think you're already seeing it in currencies. I mean, currencies are already hyper volatile. I think that we will at some point this year get a 5% pullback in equities. I think we now have the longest period in history without a 5% pullback in equities. So I think we will get a 5% pullback sometime this year. I'd love it if it comes earlier rather than later. But I do think that equities are continue to do well. I think that I think we're going to have volatility in fixed income markets is where I really think we're going to have volatility this year. I think this is the year that the 40-year bull market in bonds comes to an end.
We found out from the Federal Reserve minutes that were released from 2012 that Jerome Powell, who's going to be the new Fed chairman, admitted that the Fed buys shorts puts on the VIX. So we know now that that's like a central bank intervention trade. We know that a lot of people have, whether it's investment banks or day traders, have piggybacked that trade. So I think that's one of the most overcrowded trades in all of finance is the leverage short volatility trade. The other one is, long FANG stocks, passive investing, long general stock market ETFs. So, those things could blow up. I don't know if they'll blow up in 2018, but I'm not going to predict that they're going to keep going up for forever. It's kind of ridiculous without any corrections, really.
Yeah. Well, that's it. So because I think interest rates are going to go higher, I think tech will go higher, but I think that the FANGs will not have the big breakout year, like they have for the last couple of years where they've been the big determinants of the market. Most people don't realize this, but in a lot of these tech names, they have an embedded interest rate trade in them. And as interest rates rise, these high-flying PE names typically tend to contract more than their compatriots. So I think that there's going to be higher volatility this year. I hesitate to say it because I think it's a very easy thing to say.
Yeah, I think the key is trying to figure out where the volatility occurs. So, I would have bet on copper, the copper price volatility, because copper had a big rally about 6 months ago, and I was shocked how much of a rally it had. And I was expecting a pullback, and we got it. Yeah. So, but I could also see, games continue in the futures market with copper where there's no premiums on the real copper for the actual copper. And the futures market has like a short covering rally or short squeeze too. So, just ridiculous volatility in those things, especially with if you believe some of the GDP numbers in China. I've heard real GDP in China maybe 11%, which would add to this Austrian credit bubble that we're seeing because China is going through that real estate market, kind of like 2002 to 2006 of the real estate market here in the U.S. That's kind of, in my opinion, what China's going through right now. Yeah.
I mean, I would say the place that we're going to see the most volatility is in currencies, if I had to guess. You look at, let's go back to the dollar for a second. The dollar, has fallen almost 15% in the last 13 months. The biggest beneficiary of that dollar falling has been the euro and the yen. The euro, if you look at the commitment of traders on the euro, the speculative long positions are far and away bigger than they have ever been in history. The daily sentiment on the euro as of last night was 90 or 91. I haven't looked at it yet today, but after the move today, well, it depends. Yeah, because it did end up a little bit higher today. Intraday it was up a lot, but then it came back after Trump's comments. I'm guessing that it's still around 90. So those are extreme levels. With a huge commercial short position, a huge spec long position. The DSI, their daily sentiment on the euro in the 90s, and the daily sentiment on the dollar in single digits. Even if you hate the dollar and love the euro, we're due for a short-term, reversal. And with that big of a position in the speculative longs, I think you could see a violent one. So anyway, I would say currencies are.
That's very interesting, Brent, because from a historical perspective, currencies really in the past, before like the crazy central bank market interventions, the last 10 years or so, currencies a 1 or 2% move in an entire year was a big deal.
Yep.
And now we get that in a day.
Yeah, and it's like currencies have become. It used to be that the outlet of the bubble would take place in the equity markets, right? But now equity markets just keep going up, and like the valve to let some of the air out of the bubble seems to be in the currencies. 2 or 3 years ago now, we saw a huge move in the Swiss franc. We've seen huge moves in the dollars. We've seen huge moves in the yuan. We've seen huge. On the Trump election, I think the yuan went from 110 to 100 and back to 120 in the space of 2 or 3 months. I mean, for a currency that's as big and as important as the yuan, or I mean, as the yen, that is an incredible move. So.
Carry trade, right, with lots of leverage. So it's all the extra liquidity and leverage in the system. The euro dollar market, I was just learning about that from Macro Voices. If you listen to that, how big that is. That's basically like a whole nother central bank.
Yep. So yeah, I find all of this fascinating. If the last week has been fairly volatile. It hasn't necessarily been kind to me because I've been a dollar bull, but I just love it. Like, I love it right now. Like, if you're not having fun in the markets right now, you should maybe not be in the markets, because this is like the Super Bowl. I was talking to a friend the other day, and to be honest, I just feel really, really grateful that people have entrusted me with some of their funds, in this market, because I don't think it's easy. I don't want anybody to think I'm being cavalier about it. I take it very seriously. I think, in the years ahead, people are going to need a lot of help and a lot of advice. But it's a fascinating time. What's happened in the last 10 years is absolutely fascinating. It may not be nice, it may not be pretty, but it's fascinating nonetheless. And I think the next 10 years are probably going to be even more so. So it's just an incredible time to be involved.
I completely agree. And the other thing is that the rules changes. The politicians and central banks are constantly changing the rules, so you have to pay attention. You cannot be, a long-term buy and hold investor unless you're in a company that is growing revenues, growing earnings, free cash flow, or something like that. But in a lot of your investments, especially in a lot of these markets, you have to pay attention because the rules change here with Bitcoin. If you're a South Korean Bitcoin investor or another country investor, they can change the rules and then you're screwed. Unfortunately, that's the new normal. Last question before I let you go, though. So what's your opinion in 3 to 5 years? Are we going to have Dow 40,000, a stock market crash, or both in the next 3 to 5 years?
In the next 3 to 5, I'll say both. I do think we'll probably go that high, and then I think we'll probably have a monster crash.
I've been asking all my guests lately that question, and almost all of them to a T have said both. And I've tried then to ask them like the order. I think both of them are high probability that we will have both. And then the question is then the order. So do we crash first, and then the central banks, overreact and do like dollar devaluation, like what you were saying in 1934? What happened? Do that now. And then QE or whatever, and then that creates like asset price hyperinflation?
No, I think what's more likely is that sometime in the next, call it 12 to 18 months, we'll have a 5 or 10% correction. That'll get everybody ultra bearish. Everybody will be calling for 2008 again. Everybody will be calling for this or that. And I think it will just rocket higher. And I think we will. I don't think we're going to go. I don't think we're going to see the lows before we see the highs. So I think the blow off top will come first. And then after that, we'll see the waterfall.
It's been a fascinating discussion with you today, Brent. I really enjoyed it. This was actually my first time interviewing you because Mo interviewed you in the past. I really enjoyed this discussion today. And, with the 5% correction, it'll be interesting to see with that parabolic margin debt, how if people can pay the margin call. So
yeah, absolutely. It's going to be fascinating. It might not be fun, but it's going to be fascinating.
Well, I want to thank you again for your time today, Brent. And if our listeners want to follow your work, watch your videos, follow you on Twitter, or check out your fund, how do they do so?
You can go to SantiagoCapital.com. You can reach me at Brent, Brent, at SantiagoCapital.com. On Twitter, it's at Santiago AU Fund. So happy to follow up or answer any questions that people have.
Excellent. So I think 2018 is going to be a very interesting year. And we'll see what happens with the dollar, and we'll see what happens with gold.
All right. I'm happy to come back anytime.